Understanding market repricing, what's really happening in U.S. stocks. Let's take a step back for a moment. Last week, U.S. stock markets pulled back. The S&P 500 dipped. The Nasdaq lost more ground. Tech and software names took the brunt of it. Now, this might feel alarming if you're used to headlines screaming market crash. But here's the thing, this isn't panic. It's repricing. And understanding repricing is crucial for anyone who wants to think like an investor. First, let's look at the bigger picture. Economic data has been mixed but not alarming. Inflation is showing signs of cooling, which is good. It eases pressure on the federal. At the same time, the labor market remains relatively strong. Jobs are holding, wages aren't collapsing. Then there's earnings. Some companies are navigating this environment well. Others are guiding more cautiously. The result? Markets aren't crashing, they're recalibrating. A major driver of recent volatility has been the tech sector, especially software and high-growth names. Artificial intelligence is the long-term story. But investors are now asking, how much of AI-driven growth is already priced in? When expectations are high, even good results can disappoint. That's what we're seeing. Multiples are compressing. Profitable companies with sustainable cash flow are starting to stand out, while overextended growth bets are being reassessed. The lesson here, markets don't move on good or bad news, they move on expectations versus reality. Even though inflation is easing, it hasn't fallen enough to push interest rates down aggressively. That matters because the cost of capital affects valuations, especially for growth stocks that rely on future earnings. Investors are starting to focus on fundamentals, cash flow, profitability, and balance sheets. That's exactly what disciplined investing looks like. The real story is rotation. You might have noticed money is moving between sectors. Growth stocks, especially tech, have cooled. Meanwhile, sectors with steadier earnings, energy, materials, consumer staples, industrials, are seeing rotation inflows. This isn't fear. It's investors reallocating capital toward stability. It's a normal part of market cycles, and it's something every investor should understand. Despite recent declines, major indices are still up year over year. This isn't a broken market. It's a market testing new conditions. Markets are asking, is growth accelerating or slowing? Is inflation under control? Are corporate earnings strong enough to justify current valuations? Will interest rates fall soon or remain elevated? When markets lack clear answers, we see consolidation and rotation, exactly what's happening now. But what should consumers and investors take away? Here's the takeaway for anyone looking to make thoughtful investing decisions. Focus on fundamentals. Look at companies' cash flow, balance sheets, and profitability, not just headlines. Diversify across sectors. Rotation creates opportunity, but it also exposes weaknesses if you're concentrated in one narrative. Think long-term. Don't react to every pullback. Markets often digest before moving to the next trend. Understand repricing. Pullbacks aren't always losses, they're recalibrations that reveal which companies are resilient and which are vulnerable. Here's our closing thought. Right now, the market is balancing multiple forces: inflation trends, labor market strength, AI optimism, earnings reality, and interest rate expectations. This creates selectivity. It rewards investors who focus on fundamentals over hype, who understand valuation, and who are patient. So when you hear about pullbacks, rotations, or sector shifts, don't panic. Instead, ask, where is the market rewarding discipline? Where is it overpricing risk? Because that's exactly where the next phase of opportunity lies.